The headline number looks alarming. Australia's economy is going backwards. The latest GDP numbers show a steep fall in growth in the first quarter of the year. And it's the worst quarterly result since the recession of the early 1990s. Here are the details. Gross domestic product in the March quarter was down 1.2% on the previous 3 months. Analysts had been expecting a 1.1% fall. But it's being seen as a temporary blip caused by the floods in Queensland at the start of the year. Well, let's go to Rob Henderson, Chief Economist with NAB in Sydney. So, Rob Henderson, a bad number was expected, and it's all due to the floods?
Well, I think it's not all due to the floods, but it does look like most of it's due to natural disasters. As well as the floods, of course, we had the cyclones in Queensland, and there were cyclones off the West Australian coast too in the northwest, which disrupted iron ore and energy sales out of those ports. So, if you look across the industries, you find, Ros, that mining was the largest contributor to the fall. It contributed 0.6, but agriculture and manufacturing were both significant negative contributors to GDP as well. In other words, output in those sectors fell, and again, we think even for manufacturing that probably reflects more than anything the bad weather.
So will this stay the hand of the Reserve when it comes to putting up interest rates?
Oh, look, the Reserve Bank, we think, will still have a bias to increase interest rates. And in fact, when I look at the domestic demand indicators in this report, for example, overall domestic demand still rose by 1.3%, but it wasn't enough to offset the weakness in our exports. And also wages, the total wages bill in the economy grew by 2.9% in the quarter. So it looks like outside of the flood-affected industries that things are still going well, but will the RBA increase interest rates in June? We think it's pretty difficult against the background of one of the worst GDP numbers we've seen since the early 90s, or the worst, as you said. And I guess the other point I'd make, though, is that some of the partial indicators recently, such as the RBA's own credit figures and housing numbers, they've all been weak as well. So it's not a good background for a rate hike in June, that's for sure.
But what about July?
Look, we still think July is a possibility, and I say that against this background of pretty solid domestic demand with reasonable household consumption, very strong business investment in these numbers today. So the economy is doing what the Reserve Bank expected it to do, but that, I still think we'll need to see some of the later numbers from April, May, June coming out before the RBA will be ready to pull the trigger. But July is still quite a significant possibility, I think, Ros.
And won't the strength of the dollar be enough to stay the hand still further?
Not at all. I mean, I think the Reserve Bank believes that the strong dollar is actually an indication of how strong the economy is and how willing investors from overseas are to put money into our economy, and you can see that in the strength of our investment numbers today. So rather than being a hindrance, I think the strong dollar is something which the Reserve Bank interprets as an indication of the underlying strength of the economy, Ros.
Rob Henderson, thank you.
That's a pleasure.